A weak economy, high jobless rate, and worries about Europe's debt and ours conspiring to take stocks lower for 7 weeks in a row. If you're checking your retirement portfolio, you've likely noticed. That's why we need Doug Flynn to give us a little pep talk. He's a certified financial planner at Flynn Zito Capital Management. First of all, what's going on here, and what does it mean for our retirement?
Well, there's a lot of concerns globally in Europe and Asia, and that's weighing down on the markets. And the markets had a really nice run if you look at it from the low. So there's an opportunity for people to take some profits if you were investing throughout all of this. At the last time it was really low and people said I should invest, they did invest, and now you're up big on that part. So those are some of the things that are going on. If you're a short-term investor, these are concerns. If you're a long-term investor, this might be an opportunity. Somebody
who's a moderate investor, 25 to 35 years old, somebody who's just maybe landed their first job or just getting underway.
Sure. So what you want to do is you want to probably, and you can be moderate, conservative, or aggressive. This is a moderate. You would add or subtract accordingly, but you want to have a certain amount of money in stocks, as much as you can handle, as much as you can afford to sleep comfortably at night with for the long term, because when you're in your 20s and early 30s, this money is going to be invested for many decades. And so the big difference there, besides all stocks, is to have some alternatives. So in a period of high volatility, things are going on up and down, or if we're in a sideways market for a while, the alternative strategies, the commodities, the things that go in there are ways to take advantage of that, even if stocks aren't going to be the best performer.
And that's just a little slice of the portfolio. In your 30s and 40s, you start talking about having children, saving for, you know, their education.
That's right.
You've got a mortgage maybe. How should you be allocated as you get into your 35 to 44 range?
Right. So generally, you're going to back off a little tiny bit on stocks, and what you're going to bring in more here is bonds. And bonds, it can be a dirty word if you don't know what you're doing in a rising rate environment. But what you'll want to do there is take advantage of more of a diversified, each of these periods, the stocks, each of these areas, the stocks, the bonds, and the alternatives. You want to have a diversified portfolio of each. In the stocks, you want to have large, mid, and small. In the bonds, you want to have different types of bonds.
And when you say large, mid, and small, you mean large companies, and mid-cap companies, and small-cap companies. So they get different kinds of exposure to whatever's happening in the market and the economy. Then 45 to 54, the moderate investor, that's the person who's looking at 7 weeks of down moves that is a little bit more concerned.
Right, and they're a little closer to retirement, but even retirement, you think, okay, 65, if I'm in my 40s and 50s, it's not just about having all my money available on the day I retire. That money then has to take care of you for the rest of your life. So you could probably have a little bit more in stocks than you might think, but your fixed income also needs to be even more diversified. It's not just a matter of buying treasuries or something like that. You want to buy a diversified portfolio of fixed income investments, and that's the kind of research you want to do, or have somebody do this for you. And the alternatives too. Remember, you have to have alternatives in all these different categories, especially if inflation kicks up.
Also wanted to, especially if inflation kicks up. If you're talking about a 55 to 64-year-old investor, someone who's getting closer to trying to decide when they're going to enjoy their retirement, they should only be about half in stocks.
They should, and again, it's because the day you retire, people think, okay, I have to have all my money available. And it's just not true. That money's going to be with you. What if you live 20 or 30 years in retirement? You're still accumulating. Hopefully, this is the time when you're in your highest earning years, and you're putting the most of money away that you can. You're still accumulating. You still want to consider yourself an accumulator. So at that point, you're still trying to get as many shares as you can, and that's why this shouldn't worry you.
Doug Flynn is always a voice of reason. When the stock market is up or down, he's always there telling you if you're disciplined and you know what your risk tolerance it is and your asset allocation as that pie chart is, you'll be fine. All right, Doug Flynn, thank you so much. My next guest went from homeless to the head of the boardroom, all while being a single parent. Next, the financial lessons he's learned along the way and the lessons he's passing on to his kids. Oh, and did we mention Will Smith played him in a movie?